Today we are going to look at the one of the most important theoretical portion of accounting in a very interesting and practical way. Now, a lot of people study accounting, but they are not really clear on the core idea behind it. And in today's AI driven world, you have got to stay ahead. So let's understand these concepts one by one in a simple way.
Hello everyone, welcome to this Pro the Journey YouTube channel. I'm Mr. Rai. I help you study professional knowledge in a simple and a practical way. So let's start.
We'll cover qualitative characteristics, accounting concepts, accounting principles, and the type of business entity. Let's start with the qualitative characteristics. Accounting information also has its own human-like qualities. Let's understand them like this. Relevance. Think about a person who gives really useful advice. You actually listen to them because their advice helps you to make decisions. Accounting information should work the same way. It should help people deciding things like, is the company making profits? Can it repay loans? Should we invest in the business? For example, if a company's sales are falling this year, that information is relevant for the investor and management because it helps them decide what to do next. Now comes faithful representation. This is like an honest person. No hide facts, no twisting story. They tell things exactly as they are. Accounting information should also show the real picture of the business. For example, if a company has a huge loan, it should clearly show that in financial statement. It should not try to hide the debt just to look financially strong. So basically, the information must be complete, accurate, and truthful. Now, apart from this, we also have something called enhancing qualitative characteristics. This quality makes information even more useful and easier to understand. First is comparability. Imagine someone whose behavior stay consistent over time. Because they are consistent, you can easily understand and compare them. Accounting works the same way. If a company uses the same method of calculating depreciation every year, then we can properly compare the profit from one year to another, or even compare it with the another company. Now the next is verifiability. This is like something that other can check and confirm. If evidence supports it, people trust it more. For example, if sales are recorded in accounts, there should also be invoice, bill, or receipt to support those numbers. That way, anyone can verify the information. Let's talk about timelines. Information is only useful if it comes on time. Late information loses value. For example, if a company releases its financial statement 1 year late, it is able to make timely decisions and could choose to invest in another company instead. So the information should reach the user at the right time. And finally, understandability. This one is simple. Imagine someone who explains things clearly and easily. You understand them without confusion like we are doing here. Accounting information should also be presented in a simple and clear way. Instead of exaggerating and using complicated technical language everywhere, financial statements should be organized properly with clear heading and notes, so user can easily understand what's going on. So overall, good accounting information is not just about numbers. It should be useful, honest, comparable, verifiable, timely, and easily to understand. That's what makes financial information truly valuable. After understanding this, move to accounting concepts and accounting principles. There would often be confusion because the terms are closely related, but they are not the same thing. Accounting principle is practical application. Accounting concept is a theoretical assumption. We'll go in detail. Now let's move to the accounting concept, where the first is the business entity concepts. Business and the owner are treated as separate. Without this concept, personal and business transaction would be get mixed up, and we would not know the true profit and financial position of a business. So, if the owner puts $1 lakh into a business, we don't just say cash came in. We record it like this: cash increases, simultaneously capital increases, and the entry would be like cash account debit $1 lakh to capital account. Now another example, if the owner pays his personal electrical bill of $2,000 from business cash, that is not a business expense, it's a drawing. Because personal and business transaction must be stay separate. Now let's move to the going concern concept. Here's the idea: we assume the business will continue running in the future. We don't assume it's going to shut down tomorrow. For example, if a company buys a machine for 10 years of use, we spread the cost over those 10 years. Why? Because we assume the business will still exist and use that machine in future year too. Next come is money measurement concept. This one is more simpler. In account, we only record things that can be measured in money. If something cannot be measured in rupee, dollar, and even in other currency, it normally wouldn't appear in the accounts. Such as a skilled employee is a valuable for business. Good customer relationships are valuable too, but since we cannot measure them accurately in money, they are usually not recorded in the accounting books. Now let's talk about the accrual concepts. This means income and expenses are recorded when they happen, not when cash is actually received or paid. Suppose a business makes a sale in March 2024 at the end of the financial year, but receive the cash in the April, which is the beginning of next financial year. Therefore, the sale is still belong to the financial year 2024. So we record it in financial year 2024 itself. Let's take another example. If electricity is used this year, the expense belong to this year even if payment happen later. Let's move to some important accounting principle. These are practical rule-based approach. Sometimes guides too while preparing financial statement. Where the first is materiality. Not every thin detail needs to full attention. Only important information is shown in detail. Small item can be treated more simpler. In short, we should consider those information which could impact. For example, if a business buys a $5 calculator, it can be directly record it as an expense. But if it buys a $5 million machine, that must be properly recorded as an asset in the books because the impact is much bigger than the earlier one. Next is substance over form. This means accounting focuses on the real economic reality, not just legal paperwork. For example, suppose a company legally shows something as a sale, but the risk and control are still with the original owner. In reality, It's not complete sale yet. So accounting record it based on actual situation, not just what the document says. Now a few more important principles. Prudence. This is basically being careful. Don't show extra profit before they actually happen, but possible losses, which prevent overstating profit and financial statement shining. For example, if there is a chance customer may not repay money, the businesses create a provision for doubtful debt. Now let's move to the consistency. Consistency uses the same accounting method every year. Why? Because consistency makes comparison easier. For example, if depreciation is calculated using by method this year, changing it every year would make profit confusing to compare, which is not good. Now let's have to look another one, which is offsetting. Offsetting basically means netting. Don't just combine everything and show one final number. Important items should be shown separately. Like sales and expenses should not be simply be mixed together to show only net profit. Separate presentation gives better clarity. Now comes a very important idea. Duality. Every transaction has two sides in order to maintain balance. One account gives, another account receives. For example, when a furniture is purchased with cash, furniture account increases and cash account decreases. So the entry becomes furniture account debit $10,000 to cash $10,000. That's why accounting is called double entry system. Now the next is historical cost. Assets are usually recorded at the original purchase price, not at the current market value. For example, if land was bought for $10 lakh, if the land was bought for $10 million, it will be continue to appear at that original cost in the book, even if today its market value become $15 million. But sometimes we also uses current value. Here, assets are shown at their present market value instant. This gives a more updated picture of what the asset is worth today. And finally, matching principles. This matching principle says expense should match the revenue of the same period. For example, if a company earns revenue this year using employee salary, rent, and electricity, then all those expenses should also be recorded in the same year. That's the way profit is calculated properly. Now finally, let's understand the different type of business entity like sole trader, partnerships, and company. First is sole trader. This is the simplest form of business. One person owns and runs everything in the business. They have full control, but they also take the full risk. For example, if the business earns profit, the owner gets it. If the business suffer loss, the owner bear it personally too. Next is partnership. Partnerships. Here, two or more people run the business together unanimously. Profit, risk, and responsibility are shared among partners. For example, if three partners start a firm, they may decide to share profit equally or in a fixed ratio. And lastly, company. A company is treated as a separate legal entity. That means the business is legally different from its owner. The owner are called shareholders. And here's the interesting part. Even if shareholder changes, the company still continue. Also, the company pays taxes separately from its owner. So overall, accounting concept and principle are like the foundation of accounting. They help businesses record information properly, consistently, and realistically.